You just applied for a loan. You have a steady job. You make decent money. You pay your bills on time, mostly. And then you get the email. We regret to inform you that your application has been declined. You stare at the screen. You're thinking, how? I make $65,000 a year. What more do they want? Here's the thing most people don't know. Banks don't actually care that much about your income number. Not the way you think they do. Because while you were busy showing them your paycheck, they were quietly looking at something else entirely. And that is what decided your fate. Stay with me, because by the end of this video, you're going to understand exactly what banks look for, why your income alone can get you rejected, and what you can actually do to fix it. Today, we're breaking one of the biggest myths in personal finance, why your income alone is not enough to get approved for a loan, and more importantly, what banks are secretly checking behind the scenes. Because once you understand this, you'll start seeing money, debt, and approval completely differently. So let's break it all down. Let's meet two people. Marcus earns $90,000 a year. He's a project manager at a tech firm in Dallas. Great salary, right? Lisa earns $52,000 a year. She's a medical billing specialist in Ohio. Solid, but nothing flashy. Now, Marcus applies for a $280,000 mortgage. Denied. Lisa applied for the same amount. Approved. How does that make any sense? Here's why. Marcus had $1,100 in monthly car payments, $600 in student loan payments, $400 in credit card minimums, and another $200 personal loan. That's $2,300 a month in existing debt. Lisa? She paid off her car last year. No student loans. One credit card with a small balance. Only $350 a month in debt. Same loan, completely different financial pictures. This is the key lesson. Banks don't just look at what comes in, they look at what's already going out. So what exactly do banks evaluate when you apply for credit? There are 5 major factors. Let's go through each one. The first thing banks look at is something called your debt-to-income ratio, or DTI. This is the big one, and most people have never even heard of it. Your debt-to-income ratio, or DTI, is the percentage of your monthly income that goes toward paying debts. Here's how it works. Add up all your monthly debt payments, car loans, student loans, credit cards, any personal loans. Then divide that number by your gross monthly income. So if you earn $5,000 a month and you're paying $2,000 in debt every month, your DTI is 40%. Most lenders want to see a DTI of 43% or lower for a mortgage. Some want it at 36% or less. If your number is higher, you're going to have a hard time, no matter how much money you make. Think of it this way. A bank doesn't care if you make $10,000 a month if $7,000 of it is already going somewhere else. They care about what's left. Next, your credit score. But more importantly, your credit history. Yes, your credit score matters, but it's not just the number. Banks also dig into your credit history, the story behind the score. They're looking for things like missed payments, accounts sent to collections, bankruptcies or foreclosures, how long you've had credit accounts, how recently you opened new credit lines. Here's something most people don't realize. 2 people with the same credit score can be treated very differently. One person might have a 680 score with 10 years of clean history and a minor mistake. Another might have a 680 with a pattern of late payments and a recent collection account. The bank sees both, and it matters. Then there's something most people don't expect, your bank statements. This one surprises people. When you apply for a mortgage especially, lenders will ask for your last 2 to 3 months of bank statements. And they're not just confirming your balance, they're watching how you handle money day to day. They do not want to see overdrafts and non-sufficient funds fees. This signals you're living too close to the edge. Large mystery deposits. Where did that $8,000 suddenly come from? They'll ask. Irregular spending patterns that suggest instability. Now here's a real-world example. Imagine a woman named Priya. She's a nurse in Arizona. Great income. But her bank statements showed 3 overdraft fees in 2 months and the $9,000 cash deposit with no explanation. Her loan officer flagged it. She had to write a letter explaining everything before they'd move forward. The deposit was actually a gift from her parents for the down payment. Totally legitimate. But because she didn't know the rules, it nearly cost her the loan. Lesson: your bank statements tell a story. Make sure it's the right one. Next, your employment history and how stable your income really is. Banks don't just want to know where you work now, they want to know how long you've been stable. For most traditional loans, lenders want to see at least 2 years of consistent employment history in the same field. This doesn't mean you can't have changed jobs, but jumping between completely different industries every 6 months, that raises eyebrows. Self-employed people and freelancers have an extra layer to deal with. Many banks will ask for 12 to 24 months of bank statements instead of W-2 forms to verify income. For gig workers and side hustlers, your income is real, but banks need to see that it's consistent and documented. Keep records, file your taxes accurately, because those numbers matter more than you think. Next, collateral and assets. Finally, banks look at what you own. If you're applying for a secured loan, like a mortgage or car loan, the asset itself acts as collateral, meaning if you stop paying, the bank can take it. But beyond that, lenders also look at your overall assets and cash reserves. Do you have savings, investments, retirement accounts? Even if they can't directly touch those accounts, having assets signals financial maturity and stability. Someone with $30,000 in a savings account who loses their job can probably still make mortgage payments for several months. Someone with zero savings, that's a much riskier bet for the bank. Okay, so now you know what banks are actually checking. The real question is, what can you do about it? Here are 4 practical steps you can start taking right now. Step 1. Calculate your DTI before you apply. Add up all your monthly debt payments, divide by your gross monthly income, multiply by 100. If your number is above 40%, work on paying down debt before applying for new credit. Even paying off one small loan can make a meaningful difference. Step 2. Clean up your bank statements 3 months out. If you're planning to apply for a loan in the future, start preparing your bank statements now. Avoid overdrafts, stop bouncing between accounts, explain any large deposits in writing, and keep those records. Think of your bank statements as a portfolio. Present them like you're interviewing for a job. Step 3. Don't open new credit right before applying. This one costs people every single year. When you open a new credit card or take out a new loan, it creates what's called a hard inquiry on your credit report, and it temporarily lowers your score. If you're planning to apply for a mortgage or major loan in the next 6 months, freeze your credit applications. No new cards, no new car loans, no zero-interest store financing. Wait until after your loan closes. Step 4. Build your financial story on paper. Banks respond to documentation. Freelancer? Keep organized profit and loss records. Self-employed, make sure your tax returns accurately reflect your income. Got a gap in employment? Have a clear, simple explanation ready. The more confident and organized your financial story appears on paper, the smoother your approval process will be. Let's come back to Marcus and Lisa one more time. Marcus learned his lesson the hard way. After his rejection, he sat down with a financial advisor and discovered that his DTI was at 48%, way too high. Over the next 14 months, he paid off his car loan early, reduced his credit card balances, and avoided taking on any new debt. He reapplied. This time, his DTI was 31%, approved. Lisa, on the other hand, had always naturally kept her financial life simple. Not because she knew all these rules, but because she'd avoided lifestyle creep. She didn't buy more car than she needed. She didn't carry a balance on her credit card. She looked boring on paper. Banks love boring. The people who get the best loan terms aren't always the richest. They're the ones who look the most predictable and stable on paper. Let's bring it all home. Banks don't just look at your income. They look at your debt-to-income ratio, how much of your money is already spoken for, your credit score and history, the full picture, not just a number, your bank statements, how you actually manage money day to day, your employment stability, how consistent your income is, your assets and collateral, your financial safety net. Understanding these 5 things puts you ahead of most people walking into a bank, because now you're not just hoping for the best, you're preparing for approval. If this video helped you, drop a comment below. Tell me, which of these 5 surprised you the most? And if you want to learn more about building real financial stability in America, subscribe. We're going to keep breaking the stuff down, simply, honestly, and clearly. Thanks for watching. I'll see you in the next one.